Welcome to Yahoo Finance Live. I'm Julie Hyman along with Akiko Fujita. Let's get you up to speed on the market action here on this Friday. And we have seen a snapping of the winning streak that we had been seeing for the major averages. The S&P 500 had been up 5 weeks in a row. That has now ended. The Nasdaq had been up for 8 weeks in a row. That has now ended. Part of this having to do with the pressure and the concerns about rates continuing to move higher. The Nasdaq leading declines again today. It's off by 1%. The S&P off by about 0.8%, as is the Dow Jones Industrial Average. But let's look under the surface of these moves and take a closer look at what's been going on this week. Jared Blickery at The Interactive has some details for us and maybe some new toys you're going to show us also?
Yes, well, I got some new tickers here. Maybe we'll have a chance to get into them. But first, let's go over the price action for the week. A bit negative here, not only today, but in this 4-day holiday shortened week. Here's the 4 days in the Nasdaq, down 1.5%. We're going to contrast that with the Dow, which is down 1.8%. So pretty similar in there. Now, interesting price reaction with, and we can see this in a lot of the heat maps. First of all 11 S&P 500 sectors are in the red. Real estate and energy are the two worst. Those are down over 4%. Utilities off more than 3%. Healthcare had been in the green earlier, but has now sunk into the red. So we saw a couple of defensive names in there, but for the most part, it has been a sea of red. Now, one exception in the leaders here, we have Bito. That's a Bitcoin ETF. And in fact, crypto has been popping this week. Home builders, not too bad either, but KWEB, sea of wet red over in China. Regional banks taking it on the chin. TAN, that's a solar ETF. Memes, we know what they are. An ARC disruption. All of those names flashing danger. But let's go to the one sea of green. And I was noting that in crypto, we had some ETFs for Bitcoin, spot Bitcoin ETFs filed this week, so we saw some positive price reaction there. This is only over the last 4 days. Let's check out the last 7. Bitcoin up 17%. But I'm going to now go through some of our stock heat maps. Here are the semiconductors. These have been flying high, but not this week. A number of these names coming off 6 straight days of losses. AMD is in that group, down 8% over this 4-day period, as well as Broadcom. That's down over the last 6 days as well. Here's ARK Invest, not doing that well. China, sea of red, as I said. Energy, a lot of red on your screen. Banks, similar story. So where are we seeing some green? A little bit of defensiveness in the RX. That is a pharmasphere. Some of the larger names do play that defensive role. Merck up 4%, Lilly up about 2%. Where else was I seeing some green? Guess what? Auto dealers, you might not expect it. You got to take out Carvana. Carvana's down 13%, but CarMax up 7%, AutoNation up 3%. Interesting mix to see home dealers, auto dealers, and crypto up, while just about everything else in the tank here.
Yeah, I don't know what
Bitcoin.
the sort of rhyme or reason is there.
Yeah, I don't think so.
Well, I was going to say Bitcoin up, at its highest level in more than a year. So there you go on this Friday. Wall Street heading for a losing week, weighed down by the Fed's hawkish talk on inflation. Fed Chair Jay Powell saying we have a long way to go to get inflation down to the central bank's 2% target. Yahoo Finance's Jennifer Schomburger all over the story all week long, making some headlines along the way. Where do we stand now?
Hey there, Akiko. Yes, what a week it was for Fed speak. Fed Chair Jay Powell reiterating during 2 days of testimony on Capitol Hill that the central bank expects to raise rates 2 more times this year, but will slow down the pace so as to avoid tipping the economy into recession.
The strong majority of the committee believes that it will be appropriate to raise the federal funds rate again once or twice by the end of the year. A strong majority came down on twice between now and the end of the year. So I think the data will tell us what to do.
But when those hikes occur remains unclear. The market's certainly expecting a rate hike in July, but regional Fed presidents this week wouldn't commit to whether they'd favor another hike then. San Francisco Fed President Mary Daly is one of the Fed's members who favors 2 more rate hikes this year. But she told Reuters she wants to move slowly and hasn't made a decision about July yet, saying giving another 6 weeks to make a decision makes sense. Meanwhile, Richmond Fed President Tom Barkin said Thursday he's still, quote, waiting for the haze to clear before deciding whether to hike rates further. He said he's willing to do more if inflation is persistent, but he isn't prejudging what the Fed should do at its July policy meeting. Chicago Fed President Austin Goolsbee said Wednesday he also isn't sure how he'll vote at the July meeting, characterizing the outlook as, quote, foggy, and noting that the next several months will show whether the Fed has done enough to fight inflation or needs to do more. Now, Atlanta Fed President Raphael Bostic told me in an interview this week that he would favor holding rates at the current level of 5 to 5.25% through the end of this year. When I asked him whether he would vote against a rate hike in July, he had this to say.
Next several weeks, I'll have a much better sense of what we need to do. But again, I do feel like we're in a position now where some patience can do us well. And look, I really want to try to do all I can to make sure that we avoid significant economic downturn.
Of course, last week, the Fed held rates steady after 10 consecutive rate hikes. Powell reiterated this week that the Fed will make interest rate decisions meeting by meeting based on the data. Back to you.
Okay, and we've got a few more weeks to go until that July meeting. Jen Schomburger, thanks so much for that.
Well, central bank leaders deliver a hawkish tone this week as messaging of rate hikes are not over and done with as investors might have thought. And Jay Powell pointing to further rate hikes this year, despite the recent pause, raising eyebrows on the Fed's judgment, perhaps, in some quarters. Here to discuss is Nancy Tengler, CEO and CIO of Laffer Tengler Investments. And she exists in one of those quarters that is questioning the Fed, right, Nancy? So talk to us about where you think the Fed should go from here and where you think it will go from here, because I'm guessing those are not one and the same thing.
Probably not, Julie. Thanks so much for having me. I think one of the things that stood out for me at the press conference was there was, as always with Fed Chairman Powell, a lot of contradictions. And so if you step back, I'm not sure which data they're depending on, but if you step back and look at the core CPI number that came out last month, what you see is that there were three components that comprised 99% of the total number. So shelter was 0.22%, used cars were like 0.15, and then you had car insurance at a fraction. But that added up to 0.43, which was 99% of CPI. We already know from the current data, I guess I should say, that housing has rolled over pretty materially. And I included a chart in my talking points that was from the Wall Street Journal. It just shows Zillow and a number of other current indices showing that housing is coming down. So that will start to show up in the CPI numbers. And then the Manheim used car index in June is running at a monthly rate of about negative 0.6%. And so I think once those numbers start to be reflected in CPI, we will see some meaningful decline. We already have seen a decline from 9.2 to 4. And if you think about historical inflationary periods, inflation has gone up mostly symmetrical and come down mostly symmetrical. So we're 15 months, it took us 15 months to get to peak inflation, and we're about 9-10 months into the downward trend. So I think the Fed would be wise to pause a little bit longer. And I would also just appreciate it if they'd all kind of stop talking and contradicting each other.
Nancy, as far as the messaging, I mean, is that partly intentional? In other words, allowing the central bank to have options at its disposal because of some of the very issues you mentioned. Yes, there is the data that's come out that points to sort of cooling down of inflation, and yet we keep hearing over and over from Fed officials that we're still in this lag period, and they don't have a clear picture of the extent of the tightening and the impact on the economy so far.
No, that's a valid point, Akiko. I think one of the problems is that, and it started at Jackson Hole in 2020, I think it was, where they decided to become what they call data dependent, which is really another word for looking backwards. There doesn't seem to be sort of a guiding philosophy going forward. They've been laser focused on the labor market this time, and they were also laser focused when they neglected to start hiking rates for almost a year after inflation started. They were laser focused on labor then too, because remember, people were getting checks to stay home. The participation rate was not coming back, and so that caused them to continue to wait. And now they're kind of making the same mistake in reverse. And so I think one of the problems is that DC is not the United States. It's its own world. And so if you look at all the data that we're looking at, it seems like the work has mostly been done, and the danger is that the Fed hikes too much. I don't think 25 basis points is going to matter one way or the other, but I think this constant roiling of the markets is not good for investors. It's certainly not good for individuals who are trying to plan their lives around, rising interest rates and high inflation.
Well, but at the same time, when they say they're data dependent, I mean, even the concurrent data that you mentioned, some of it is mixed, right? And it seems to me that when we hear Jay Powell sort of trying to couch his language or maybe contradicting himself at times, it's almost as though perhaps he's being overly transparent, maybe, because he doesn't know. And I think that maybe a lot of the smartest people out there don't necessarily know what is the absolute right decision right now. I don't know. I mean, it's a tough job to try to figure this out.
It is. But, what we do know is that this was the fastest hiking regime since the 1980s. And if you looked at the way that policy was driven then, they're trying to avoid that, but it's a very different situation. And so I think when you have a sort of self-inflicted wound of letting inflation get out of control, and you've got fiscal policy, it's not all the Fed's fault, to be sure. And we've written a lot about this in Mr. Magoo's Washington. And then in my most recent piece, it's time to replace the Fed with GPT. Because I think what we've seen is a Fed that's unwilling to learn, but he's also been unwilling to call out Washington on all the spending. And if you look at when inflation really got out of control, it was when the American Rescue Plan was enacted long after we were getting vaccines and people were going back to work. So it fanned inflation further and created this problem for the Fed to try to solve, but they don't have to solve it in a vacuum. And I wish we'd see more rhetoric coming out of the Fed to Washington to kind of cool down the spending for a while.
Nancy, let's talk about what we saw in the equity space this week. A bit of a cool down, you could argue, at least within tech. We saw the sector see $2 billion of outflows in recent trading days, at least according to a Bank of America note. This all came, of course, after proclamations of a baby bubble formed by the latest rally. That's according to some analysts we've spoken to, Nancy. How do you view this latest tech rally, and have you been buying into it?
We've actually been trimming into it at Kiko. So I think I've said on your air before, we were adding to technology and consumer discretionary last fall. It was hard to do. It always is hard to do at turning points. We didn't know if we were in a turning point, but what we knew was we were getting tremendous valuations when you see a stock like Microsoft at $214 a share. I mean, that was the bottom. That's not necessarily where we bought it, but we just added to it. We added to a number of the names: Adobe. We added to ServiceNow. We added to Chipotle. We added a position in Tesla, Lululemon. The Tesla position came in January. But now we've been net sellers or trimmers of these holdings because they've appreciated dramatically. And we've been diversifying our purchases out into industrials that we think will be one of the next beneficiaries, though we do not believe that the tech rally is over, and we don't think it's a bubble. I was managing money in 1999 through 2002, that whole period. Many of those names were trading at 100, 130 times peak earnings. We're not in peak earnings, and the valuations are much more reasonable with a secular tailwind, not just AI, but cloud as well. And I'll just add that you're seeing from the companies that have benefited from AI, like a Broadcom, which we still like, and Oracle, they're seeing tremendous levels of growth in the next 3 to 5 years. And AMD CEO came out and said, they're going to see 10 to 25, 50% growth over the next 3 to 4 years.
And so we're going to get more to Tesla in just a minute, but when you look at some of the other large cap tech stocks, especially those that have been fueled by the enthusiasm over AI, where do you think we sort of are in that cycle, and where the stocks are going to go from here?
Well, Jill, I think the total addressable market is yet to be known, but it is going to be quite large. And I commend your viewers to read a piece by Mark Andreessen on AI, what it is and what it isn't. It's posted on their website. Do I think NVIDIA is somewhat overvalued? Yes. Did I think Amazon was overvalued for many decades? Yes, and I was wrong. So you know, one of the things you have to learn in this business is how to adapt. And so what we're looking at is valuation based on our own proprietary metrics, and then we're looking at the total addressable market. And we're early days in this adaptation to AI. We know we still have a lot of room to run in cloud computing, and the combination of the two, which is what Oracle talked about in their earnings call, has proven to be quite compelling in terms of growth. So, you know, let it settle in. You never want to chase these kinds of rallies, and we don't. Volatility is the friend to the long-term investor, and I think you'll get some better entry points in the coming weeks. But, you know, you have to be willing to step in like we did in October, because you don't get many of these opportunities in the long run.
So, Nancy, that brings us to a stock that I know you have been bullish on for some time, and we're talking about Tesla. We saw the stock get 3 downgrades in 3 days, the very latest being a double downgrade by DZ Bank, shifting from a buy to a sell rating. Going back to some of these notes that we saw, you know, we heard Barclays talk specifically about this outsized expectation on AI running ahead with the stock, when in reality there were still some challenges on the EV side of things. How do you view this recent run-up for the company? And you think investors are maybe getting a little too ahead of themselves, especially on the AI side of the business?
I do, Kiko. I think just as I thought last fall and into early January that the stock was just being relentlessly punished for no particular reason. I mean, you heard analysts come out and say, well, Elon Musk bought Twitter, he can't run 2 companies or 5 companies, whatever it is. And in addition, you know, he's taken a political stance and people are not going to want to buy Teslas. I mean, that kind of nonsense scares people out of the stocks. And so what you have to do as an investor is you have to look at, you know, is this management team visionary? The answer is yes. Has he been a good executor? Yes. He's got a fabulous CEO. The volatility to the upside and the downside has always been extreme in this stock. So you use it as an opportunity. When it gets out of whack like it is now, you trim it back. And when it comes back in, you have to have the courage to step in and buy it. I don't think some of these upgrades and downgrades have been particularly useful in the history of my career over 40 years. What you really want to do is pay attention to the facts that Wall Street present, and then step in and use your own judgment on buys and sells. And so that's what we've done, and we will continue to hold it. We're not adding in here for sure, and if we get an opportunity to trim back, we will.
Okay, Nancy, stay right there. We've got much more to come from you. We're going to be getting into some of those stocks that you say are a buy and others to avoid in just a bit. But we are just getting started here on Yahoo Finance Live. Coming up, Nikola's stock falls as some of its semi-trucks catch fire at the company's headquarters in Phoenix, Arizona. We've got more details on those developments. Plus, we head back to the south of France as Brian Sazi speaks about the impact of AI with Pinterest CEO Bill Reddy at the Cannes Lions Festival. And at 4 p.m., Julie catches up with adventure author and TV host Bear Grylls to chat educating and empowering young digital explorers. All that and much more when Yahoo Finance returns.
The priorities of today for the entertainment business were our priorities yesterday, right? Like at the beginning stages, we wanted to be an example of the change that we wanted to see. So our infrastructure is one that's full of color, a landscape of inclusion, right? Because that's what it's supposed to be.
Heartbeat, Kevin's the North Star and sort of the heartbeat of the company. We're working with so many amazing creators across audio, TV, film. And, I think what's really exciting about Heartbeat is it serves as a platform that he's created for the next generation of not just comedic creators, but just creators in general.
Power culture. And that's a big word, everyone uses it, but we set that as our North Star to really become a cultural icon. We're McDonald's, so we shouldn't just be participating in culture, we should be creating it, which means if you're gonna do it externally, that gives you a thought to how you have to build that culture internally. And that's really what's been the driver of the business for the last 2.5 years.
This is one of the most, if not the most, inclusive brand in the planet. For a portion of population today, particularly Gen Z, ESG, your level of commitment on ESG, it matters. And for others, it's innovation. So the name of the game for us is growth.
The biggest concern, I think, for talent, at least Hollywood talent, would be how long does the writer's strike last? How bad is the pullback by the streaming companies in terms of how much they're willing to spend on content? On the other side of the coin, in the music business, where I spend a lot of my time, it's never been better. The live music business is off the charts.
Everybody wants to know, what's the state of that market is. Are things going to come back, storming back? I'd say, look, things are pretty stable. I think that's the sentiment here. People fear a really tough 2023. It's not the fastest growing year ever, but things are pretty stable in the industry. And I think a lot of business is getting done here.
As major U.S. benchmarks head toward a losing week, we are taking a look at names investors may want to consider avoiding and stocks worth another look. Laffer Tengler Investment CEO and CIO Nancy Tengler is back with us. And Nancy, let's start with one of those stocks you really like, and that is Broadcom. An interesting pick here, just given the action that we have seen within semiconductors. How much of this has to do with the strength that we are seeing in their custom chip business?
Well, Kiko, this is an extraordinarily well-managed company, and we like the VMware deal. We think that management expects it to go through in the third quarter. They have a great capital allocation plan for shareholders, so they return, a significant portion of free cash flow via dividend increases and stock buybacks. But in addition to that, they expect that their enterprise AI computing business is going to grow from 10% to 25% in 2024. They just inked the deal with Apple for chips. And so there's a lot going well. The stock has run a great deal. It's still fairly attractive on our valuation work. And so while we've been trimming it because it's overweighted, if it pulled back, we would still add to it. And with fresh money, we are still committing a significant portion of our portfolios to the stock.
Another one of the stocks you liked that caught my eye was Spotify, and that company is recently, or there are at least reports that it is going to be offering a new premium tier. And it's interesting that we're seeing sort of parallel activity in music streaming to what we've started to see in video streaming in terms of adding more pay tiers, for example. Is that what's sort of drawing you in here, or are there other things you like about Spotify?
That's such an important point, Julie. Yes. I mean, they have not raised prices since 2011. I used Spotify, then I shifted to Apple Music. I'm going back to Spotify because Apple keeps raising the price and Spotify's format is just a lot better. But so they have the pricing power levered to pull, but they also showed fiscal discipline. So they're laying off 200 people in the podcast business. They've kind of regrouped that business. It hasn't been, outside of Joe Rogan, it hasn't been terribly successful. And they own 33% of music streaming. So I think, their ecosystem is pretty sound. And if they can leverage that and continue to focus on expansion and profitability, the CEO thinks they'll be net income positive in 2024. That's important. This stock has lost money for a long time. So we like the way they're managing the business. And we think they have not only brand dominance, but the opportunity to raise prices. And as you point out, the premium business is another way to improve margins.
Nancy, let's talk about one of the names you say that investors should stay away from. One of them, CVS here. I'm looking at the chart, and it's not a pretty one so far this year.
No, and Kiko, I think we were not enthusiastic buyers in the first place. We added a position a couple of years back. Karen Lynch is a compelling CEO, but then she proceeded, I think, to kind of have acquisition FOMO, and so they made a number of acquisitions after being very disciplined about paying down their debt from the Aetna merger acquisition. They made these acquisitions that aren't going to be accretive for years. And so free cash flow is going to be muted, and we're a little bit concerned about the sustainability of the dividend. We just can't find the catalyst for outperformance. So we exited a number of months back. It was still a bad portfolio decision, but sometimes I've learned, as a value manager, sometimes you want to buy more, and that's always your instinct. But our decision was that there were much better places to be, and the opportunity cost was too great to wait for this one to play out, especially if the dividend becomes at risk. Certainly dividend growth is going to be at risk.
Nancy, another area more broadly that you don't like is in consumer staples. This has been such a fascinating area to me this year just because of the pricing power narrative that so many of them have put forward, right? So many of them talked about that volume wasn't doing well, at least on the sort of consumer products side, right? Volume wasn't well, but they were able to raise prices. So how are you thinking about it and framing this group as we go into the second half of the year, especially with your thesis that we're going to start to see inflation abate?
Well, yes, great points all. I think a couple of things. One, the stocks are pretty fully valued, and that's important to us. We still own names like Procter & Gamble because they do have pricing power, but we've also, I guess, embraced a theme for the last 2 years of old economy companies that are embracing the digital revolution, and then those that are supplying the arms, if you will, to digital adaptation. So in the consumer staple space, there are a couple of names that you could say, more in the discretionary space, like McDonald's and Chipotle, that are embracing digitization. But what we've decided is we eliminated Philip Morris from our portfolio, again, because we couldn't find a catalyst. It was a great defensive name during the bear market last year, but there's limited growth. They've really been growing the dividend quite slowly. And, it's a business that you really buy that stock for the dividend because it's not a high growth business. So we've selectively reduced our exposure in staples, and we will probably continue to do so because we're finding a lot of attractive names in industrials, which tend to do really well coming out of periods of low manufacturing PMIs, contractionary PMIs. So that's where we're repositioning ourselves for the next leg up, and we still are overweight technology, healthcare, industrials, and energy.
Okay, some good takeaways as always. Nancy Tengler, thank you so much for joining us today. Really appreciate the time.
Thank you.
We are watching shares of Nikola today. They have been trading lower by about 8%, and this comes after the EV maker revealed it suspects foul play in the early morning fire that affected multiple battery electric trucks at its Phoenix headquarters. Yahoo Finance's Prasubramanian has the details. First of all, what exactly happened with this fire?
So early morning today in their Phoenix headquarters, there was a fire that broke out at their world headquarters in Phoenix. 4 trucks, battery electric trucks, were on fire, and we have some pictures and video of that at the scene there. And this is where Nikola put out a statement saying that they suspected foul play. Now, the Phoenix Fire Department is investigating. They have not released a reason or cause for this fire, but seems somewhat suspicious because Nikola said they saw a vehicle nearby the scene of the crime right before the fire happened. So this comes at a bad time for Nikola. They just announced last week layoffs at the company based on their split with their European operations with IVCO. So that happened there, and CEO Michael Loschler is trying to actually change the business and trying to focus more on the hydrogen electric trucks and build the battery trucks more and build to order. I think there's more potential for a gain for them in the hydrogen space. So they're doing that there, and they build around 60 trucks a quarter or so, and they want to ramp up that even more. Unsure how this affects their operations. Hopefully it's just the existing trucks, but who knows with what's going on there.
Yeah, Pras, that was my question. I mean, to what extent does this set them back at a critical time when they are making this pivot? I guess the investigation is still continuing. They still have to assess, but at least the initial reaction in the market seems to suggest that things aren't looking good in the immediate future.
Yeah, we reached out to Nikkel and they said they had no further comment at this time, but they would be releasing some commentary later as they get more information, so we'll see. But I think one thing to watch definitely is, does this affect their outlook for the 300 to 400 trucks I guess they want to build by the end of the year, so we'll see about that.
Meantime, Praz, let's talk about J.D. Power out with its initial quality study. What are some of the brands that perform the best?
This is a widely followed kind of car tracking sort of thing that people look at when they talk about quality, overall quality. This is initial quality, first 100 days of ownership, and big day for Stellantis, right? So we saw Dodge, we saw Ram Trucks, we saw Alfa Romeo, all Stellantis brands. They're the top 5 most highest initial quality. You see Buick and GM's Chevrolet rounding out the top 5. So good news there for them. Now Dodge doesn't have that many vehicles in their offering, but still nonetheless not bad. What we're seeing across the board though is what J.D. Power is saying is there's actually less reliability these days overall compared to last year because of a lot of technical advancements that lead to sort of snafus and bugs and things like that happen with these newer vehicles. Now, I want to see that the lower 5 or the bottom 5 are not that great here. Infiniti, Audi, Volkswagen, those 2 brands are sort of known for little bugs here and there, especially Volkswagen. Chrysler, a Stellantis brand, they're very interesting down there at the bottom, and then also Volvo.
There's one name that I don't think I've seen on any of these lists, the top 5 or the bottom 5 yet, and that's Tesla.
Yeah, well, J.D. Power did rank Tesla as it was an unranked brand there because they don't allow tracking of owners in states that don't authorize tracking, right? So in some states, if you don't authorize tracking, the automaker can say, hey, can we still track your initial quality? And they say yes. Tesla and Polestar don't allow that.
Huh. So when we talk about tracking of accidents, breakdowns, that kind of thing?
Oh no, just like polling of their users based on what problems have you had with the car, design-wise, infotainment-wise, that sort of thing. Huh. Some states don't you need authorization from the brand to do that, and Tesla won't allow that, right? So what happened is that J.D. Power then used survey data and other types of ways to sort of project what that would be, and Tesla and Polestar both were below the bottom 5 brands. So they supposedly have a lot of initial quality issues, but it's not part of an unranked, it's an unranked brand there, both Tesla and Polestar.
That is fascinating. Ross, thanks very much. Appreciate it. Well, coming up, how are tech companies using artificial intelligence to make their apps more efficient and user-friendly? Brian Sozzi caught up with Pinterest CEO Bill Reddy at the Cannes Lions Festival. Stay tuned for that conversation.
Part of the cool thing here at Cannes Lions is chance meetings. So we have the Yahoo Beach House right next to the Pinterest, really epic beach house, and I'm here with CEO Bill Reddy. Bill, good to see you.
Yeah, great to see you as well.
Not in the studio and not talking about earnings for a change.
Yeah, thanks for dropping by.
I like it. So talk to us about the next iteration of that positive mention or that positive focus or a positive place to be on the internet. What does that look like next for you guys?
Yeah, one of the things that we've announced here at Cannes is the Inspired Internet Pledge, which is, we've been designing positivity into the platform at Pinterest for years, but we really think that positivity and particularly more positive outcomes in emotional well-being really needs to become a standard for the social media industry. So we announced that here at Cannes with the Digital Wellness Lab that's really asking all of social media, advertisers, agencies, the whole industry to really come together and support more positive emotional well-being outcomes, to commit to measuring those outcomes, to delivering better outcomes over time, and then sharing learnings with each other, because really, emotional well-being ought to be a mandate for all of us, not something that we're competing on, but actually a mandate for the industry that we all need to do better on.
This is a wildly opposing message. I hear a focus on positivity from you, and on the other side, there's Twitter trying to round up new business here at this event. Are you winning new business because of your message you're trying to get through?
We've seen really phenomenal response from advertisers. It pays to be positive on Pinterest, and we see that advertisers really want to be part of that. If you're building a great brand as an advertiser, you want to build your brand on positivity as well. And so we're seeing that advertisers and brands want to be part of that. And as we're delivering great performance, a great full funnel experience, which is quite unique to our platform as well, we're helping them connect with users in moments that matter for those users in an environment that's positive, where users are getting to create a life they love. So that's inherently positive. And we're seeing that pays for advertisers to connect in those moments as well. So we've seen really great reception to it. But we aren't perfect either. We are committing that not only are we going to measure ourselves today, but going forward and commit to ongoing improvement in those areas, because as much as we've tuned for positivity, nobody's perfect, and we want to make sure that we're learning and getting better, both as Pinterest as well as with the industry.
Each time I've talked to you in your CEO capacity, I've asked you about the state of the ad market, and each time it has sounded incrementally a little bit better. Now we're contained in here, we're having drinks, we're on a beach, everything seems rosy, the economy might be growing 10%, who knows? But what's your sense of the ad market looking into the back half of the year, at least from being on the ground in an event like this and talking to all the key people?
Well, what I would say is I think it's hard to predict the macro. I think the ad market still has spots, there are bright spots in the ad market. I think there are other parts of the ad market that are challenged, so there's sort of still puts and takes across those. But it's good to see that there are bright spots that are emerging there. And so I think that's encouraging across the industry. But I think even more than that, it's encouraging to see that the things that we're doing with Pinterest are resonating with advertisers. The full funnel nature, as we're delivering more performance for advertisers, and again, bringing that positivity for them that they're valuing. And also, they're valuing it because the people on the platform value it. We see that people come to Pinterest, users come to Pinterest, really as an oasis away from the toxicity of much of social media. So advertisers value it, but users value it too. And so we're seeing that really cut through.
Two more. Bill is an in-demand guy here at this conference. I literally have about 3 more minutes with him. That's how these meetings go. AI, have you been inspired by anything that anybody is doing here with AI and building it back into your own business?
Well, I think the possibilities with AI are so phenomenal. AI is a core competency for us. We have really been leaned into next generation AI. If you think about things like our personalization, which is really unique to our platform in terms of what people do on the platform. People curate on our platform. They associate products. How do people think about, how they're going to put a room together, how they're going to put an outfit together. AI is only as good as a signal upon which it's acting, and we have really unique signal because people come to Pinterest to go curate all the things they're interested in and make these great product associations, and that's really letting us do some unique things. So, for example, our personalization model today is 100 times larger than what it was just a year ago. And so the power of the recommendations we're able to make because of that, built on top of next-gen AI capabilities, GPUs and things like that, that's letting us make recommendations that users are saying exceed 95% plus relevance for them. So that's just one example of sort of the power of where AI is going and how we're incorporating it. So I think that is great. The other thing, just coming back to the positivity point, I think as AI gets more and more powerful, I think a really important question is the ethics of the AI, what people ask the AI to do, and I think, again, it's an important moment for people to commit to using the AI for positive outcomes. And so there's so much limitless potential, but it can be used for good or not for good, and it's a great moment to commit to those things. That's certainly how we think about it with human-centric AI, bringing that into the way people use the product, doing things that sort of respect the user and help honor what users want to do versus just sort of serving users things that may be based on what triggers them the most or those kinds of things. So we see lots of opportunity and potential in that, but also an important moment for people to be clear about what they want to do with the AI, and clearly for us, that is using it for positive outcomes.
Before we let you go, last 30 seconds, I realized coming into this, I've been following you and your CEO journey, and so have the investors on the Yahoo Finance platform. You hit the 1 year mark or coming up?
Coming up on 1 year, yeah.
What have you learned as a leader in that 1 year mark, and how are you different?
Well,
you still look great.
Thanks. Maybe a few more gray hairs, but it's been a great year. Yes, there's been a lot of choppiness in the market, things like that, but if you look at our platform, we've returned to user growth. We're deepening engagement, with engagement growing double-digit percentage points. Our ad impressions were up 30% plus year on year this past quarter. So the business is growing quite nicely. And so even as ad demand has fluctuated in the market, the supply on our platform has grown 30% plus, which is really a reflection of both deepening engagement from our users, as well as delivering great products for advertisers that's helping them to engage with users. So it's been a remarkable year. Shopping's coming more onto the platform. So we feel great about all that, but we have so much more to do. So look forward to talking about that as well.
I've been following your journey so closely, Bill, that I got the same shoes as you.
Oh,
we both got the memo, the white shoe memo here in Cannes Lions. Always, it's part of the uniform.
Yeah, I'm glad we could coordinate.
All right, good to see you. Get back to work.
Thanks so
We'll
much.
talk to you soon.
All right.
Brian Sozzi out.
The white sneaker boys over there. Thanks to Saz and Bill Reddy, the Pinterest CEO, for bringing us that interview. A new note from Morgan Stanley suggests that times are changing for sports fans, as the channels they're accustomed to watching the big games on could all be moving to streaming. Yahoo Finance's Alec Now has been watching this landscape very closely. So how do we think it's going to shake out?
Well, Morgan Stanley is out with a very comprehensive note just about sports and how it's going to play into the media world going forward. And there's a couple things that I want to point out. Number one is all these major contracts for these sports leagues, they're expiring by the year 2030. So that's going to create a lot of opportunity here for different media giants, different streaming players to get some skin in the game. Morgan Stanley laid out 3 different scenarios that could possibly play out, and I want to tick through those quickly. Scenario number 1 is that cord cutting continues to remain elevated, therefore forcing broadcasters to pull out of some of those pricier deals. As a result, big tech would step in, and we'd see some of those major streaming players, including Netflix, which has been very resistant to getting into the sports game, really leaning in on those professional contracts. Now, this would benefit the sports rights holders and franchises, as it would lead to a more competitive market. It would also be a good thing for some of those streaming giants looking to get into the game here, but it would be bad for those more traditional broadcasters. Next is scenario number 2. Now, this is a world where cord cutting rates moderate. There's a consolidation in the media world, and as a result, more streaming sports bundles emerge. So this would benefit companies like Disney, Paramount, Warner Brothers Discovery, who already have those streaming components within their respective businesses. But this scenario would be a bad thing for big tech, as prices would be higher to nab some of those more expensive sports packages. And then scenario number 3, once again, cord cutting rates moderate. We see that consolidation in media. However, we are also going to see big tech, instead of leaning into sports, they would back off due to the risk of profit losses. So this would be a net negative to those sports rights holders, since they would have fewer bids, but it would tilt in favor of the buyers, aka streamers and big tech. So there's quite a few ways that this could go moving forward.
Is there one they think is the most likely?
So one thing that I do want to point out, and that I was surprised by, is they are very bullish that Netflix is going to be a leader in the sports game over the long term. And Netflix has consistently said, we're not anti-sports, we're pro-profits, and it's just not part of our business. But because they're on this path to profitability and free cash flow, Morgan Stanley at least thinks Netflix is going to emerge, surpass ESPN, and be a major player in sports in the long term. So, you know, it all comes down to this cord-cutting situation and how broadcasters respond to it. A lot of different things, but overall, sports is going to be a disruptor for all of media. Depending on which way it goes remains to be seen, though.
So interesting. Thanks a lot, Ellie. Appreciate it. Well, coming up, the White House and President Biden are embracing the term Bidenomics as Democrats plan to grow the economy from the bottom up and middle out. Next, we're going to talk to a guy who's been using that term for a while, our own Rick Newman.
Well, tech giants are betting big on India as tensions with China remain high, and they're taking advantage of Indian Prime Minister Narendra Modi's state visit this week. Following last night's state dinner, some of those top names within the tech community spending their morning at the White House at a meeting with President Biden as well as Prime Minister Modi. Apple's Tim Cook, Sam Altman from OpenAI, and CEO Lisa Xu, AMD, CEO Microsoft Satya Nadella, and Alphabet CEO Sundar Pichai, all among the guest list. Joining us now is Axios global tech correspondent Ryan Heath. And Ryan, you know, so much of this conversation has been framed in the context of China, which certainly makes sense, given that a lot of these tech companies are looking at that, looking to diversify outside of China. But how big is the opportunity in India, really?
It's massive, and it's been going on for a long time. This isn't just a safety net strategy for dealing with the tension in China. So companies like IBM have had between a third and half of their workforce based in India for the last decade now. And obviously these roots go into very deep territory when you think about the millions of Indian students that have studied at American universities. Many of them return home. So you've got a lot of deep links, a lot of very sophisticated universities and systems that the Indian government already operates. So there's a lot of opportunity for Americans to tap into. There's a lot of talent that the American companies can use either in India or they can import people over to the States. And there really is a lot of opportunity here. And the situation in China means it's all the more important, but there's a very strong foundation to build on.
Ryan, excuse me, it's Julie here. Let's talk about the potential risks then of operating in India, because accompanying Prime Minister Modi's visit here to the United States has also been discussion of the democratic record there, his human rights record, his record on the freedom of journalists in the country. None of them are particularly stellar. And then you have Jack Dorsey, formerly at Twitter, of course, talking about some curbs on Twitter from the Indian government. So what do these companies really have to keep aware of?
Well, there's a whole suite of issues here. So let's start with some of the tech that the Indian government uses. It doesn't do it with the same guardrails that we would expect in the US or in particular in the European Union. It's very attractive if you're a technologist to say, hey, I get to work with 1 billion biometric records. But if you don't have guardrails in place, that can really blow up in your face or in the face of the people whose records you're in charge of maintaining. Then you've got the democracy situation. So the Indian government did threaten to shut down Twitter. They do demand that accounts that are critical of them be removed or be censored. So you're going to have to tangle with the Indian government. And what sounds nice at a White House state dinner is a lot more uncomfortable when you have those regulators knocking on your door and telling you might be kicked out of the country if you don't comply. So there's that level of difficulty there. Then you've got the situation where most workers in India just really aren't paid what workers in America are paid. That doesn't mean these are bad jobs, but you've got a lot of human rights watchdogs, a lot of people looking through the ESG reports of a given company, and they're going to want to know, are these sweatshops? What are the conditions of all of these workers who are manually labeling this data, the ones that are making AI seem really human? You know, there's a bunch of humans being paid $2 an hour to do that work. So you're going to have to manage a lot of reputational issues if you dive into India. At the same time, the rewards are pretty big if you can pull it off.
Ryan, what about the issue of tech transfers? I mean, this is the Indian government essentially saying, look, we'll welcome you and we'll give you access into our massive market, but we want something in exchange.
Yeah, so this is a pretty standard Indian play, and it seems a bit more reasonable now when you look at these global subsidy races that we've been seeing around chips and around other key strategic critical minerals and other exports in the technology sector. But for a long time, this was India being on the fringe, demanding things that weren't very realistic. And their attitude there is, we've been exploited for centuries by Western powers. It's time to get something back. And what it meant is that India just didn't really sign a lot of free trade deals. They didn't enjoy the economic growth that a more open Chinese economy enjoyed. But now that the US needs India, and the Modi government knows it, they know that India is essential as a hedge against China, they can really push these demands. And they're able to sign deals on military jets, some co-production between GE and Hindustan Aeronautics. They've done a drone deal. They're going to do more in terms of ship repairs, you know, outside the tech sector, but still pretty strategically important. So the Indians are squeezing something out of the Biden administration here. So it's working for them.
How reliable partner do you think India is for the U.S.? I mean, Julie sort of listed off some of the concerns around human rights. There's those who argue, look, India hasn't even condemned Russia for the attack of Ukraine. I mean, there's a lot of question marks where the U.S. and India don't see eye to eye. And yet, if you look at the state visit, the public statements that have come out so far, you'd think they're really on the same page. Are they a reliable partner for the U.S.?
Sometimes you don't get to choose your partners. So I would say that they're not the most reliable partner, but they're the partner that the US has been able to get to the table. So it's absolutely the case that the reason why we haven't seen more weapons sales and other military equipment in the past is because India's relied on Russia for that. The US, frankly, hasn't fully trusted India with intelligence and with some of that technology. They were able to do a civilian nuclear deal under the Bush administration, and there were big hopes around that. And it didn't really work out as well as planned. So if you talk to people in the Bush administration or other defense insiders like I've been in over the last week, they honestly don't fully trust India. At the same time, the only way to build trust is to do some of these deals and inch it forward. So I think when you look in the context of China and the need for as many allies and partners in the region as possible, you know, we have to work with India. I was born in Australia. Australia has to work with India inside this Quad framework as well. So it's a difficult relationship, but they've got to keep trying because the alternative is that you allow China to dominate. And that, in most people's opinion, is the worst outcome.
Axios global tech correspondent Ryan Heath. I appreciate you joining us today. Thanks so much.
Thank you.
Focusing more on domestic politics, President Joe Biden is set to announce new major economic policies in Chicago next week as he ramps up his campaigning and travel ahead of the big launch for his re-election bid. He's going to be selling his Bidenomics plan, which includes accelerating transport improvements and energy initiatives, as well as those all-important approval ratings. For more on this, Yahoo Finance's Rick Newman, a man who has been using the term Bidenomics for quite some time now. It looks like the president's gotten a clue and he's using it now too.
I'm sure he reads our weekly Bidenomics column and he finally decided he needs to get on board here. Some of us in the press just use the word or the phrase Bidenomics to refer to the economic policies Biden has pursued as president. But they're, 2+ years in, there actually is kind of a coherent theme coming together in what Biden is trying to do. And it's not just what you think of as the old Democratic policies, tax and spend. I would say Biden is trying to address a couple of problems that markets have not been able to solve during the last 20 or 30 years. The first is what to do about climate change and global warming. So Biden is directing massive amounts of government subsidies into renewable energy and incentives to adopt green energy because the market has been trying to do this and it just hasn't been able to do that. And he was able to get a big bill through Congress last year that provided hundreds of billions in incentives for green energy adoption. The other is what to do about manufacturing jobs that have left the United States, offshoring and globalization and the rise of China. And again, he's trying to use government power, mostly incentives again, to bring manufacturing, at least certain types of manufacturing, back to the United States. And it looks as if we're starting to see the early signs that Biden is actually beginning to accomplish these goals. I mean, it was big news this week that Ford took a $9.2 billion low-interest loan from the Energy Department to help build 3 electric vehicle battery plants in the South. That's the largest loan of its kind the government has ever offered to a private company. And I think we're going to see a lot more of that. So, Julie, you just mentioned Biden's going to have some announcements coming forward. I think it's going to be more of the same. It's going to be more of the execution of these 2 big laws, an infrastructure law in 21, green energy subsidies in 22, semiconductor subsidies in 22. They're now starting to roll out and put all of that into practice. And we're going to hear a lot of announcements about this in coming months. And it's going to become a lot clearer what Bidenomics actually is.
Rick, we were showing a graphic there of all the legislation that's been passed under the president. I mean, by all accounts, it looks like an incredibly productive first term, and yet his approval ratings just don't match what, at least on paper, he's accomplished. How does he narrow that divide?
No, you're right. They don't. So, but Biden, people think it's still Sleepy Joe. That may be his demeanor, but Biden has got an incredible amount accomplished during his first 2 years. Now, Republicans took over the House of Representatives, so he's not going to get any of his legislation through during the next 2 years. But he got a lot through during the first 2 years, way more than Trump got through, arguably more than Obama got done in either one of his 4-year terms. But, that doesn't mean that that's necessarily what voters want. And it doesn't mean that voters are even seeing the effects of that legislation. So that is Biden's job as he's running for re-election in 2024. The most important thing he has to do politically is get people to notice what he has done and then get them to believe that this is actually good for the majority of Americans. So, these programs, the infrastructure bill, the green energy subsidies, these are going to roll out over years, and it could be as long as a decade. So people may not be seeing this in things like a big boost in manufacturing employment during the next year or so. But, Biden is speeding this stuff. It's in his interest to get this stuff out there as fast as possible, to get it affecting the economy, and then to point to it and say, see, I did that. That's what his messaging campaign is going to be all about for the next, whatever it is, 16 months.
Yeah, the pointing to it part has been the tricky part historically, not just for him, but one could argue for the Democrats, right? And so is anything he's going to say going to be trumped by, say, gas prices or the price of milk at the store, right? Is it going to be harder to push that message if people are still seeing higher prices?
Yeah, and I think inflation is the number one reason why people are not giving Biden much credit for anything good that's happening in the economy. It's very clear that consumers have been shell-shocked by inflation. And even though the annualized rate of inflation is coming down, as we've discussed before, all those price increases are still there. Prices are just going up by less, but all the price increases of the last 2 years are still there. Incomes have not kept up. So that's a headwind for Biden. If he's lucky, inflation will abate and he'll be able to point to some of these other things. And if he's not lucky, inflation is going to be the only thing voters care about, and it's going to be tough sledding for Biden in 24.
All right. Thanks so much, Rick Newman. Appreciate it.
Bye, guys.
Well, we got the closing bell on Wall Street, so let's take a look at the market action. All three major averages finishing this holiday-shortened trading week in the red. The Nasdaq leading the declines, off by 1%. The S&P off 0.75%, and the Dow off 0.2%. And indeed, we saw the end of the weekling winning streak that the major averages had been on. The Nasdaq had been up for 8 straight weeks. The S&P had been up for 5 straight weeks, and now the S&P looks like it's going to finish the week down by about 1.25%. Let's also check in on Bitcoin prices as the rally is persisting in the cryptocurrency. It went above $31,000 today for the first time since June of last year, but the crypto token now up over 17% on the week, over 80% year to date. It's down back below 31,000, but still higher on the day, even as it has paired its advance. You know, you always have to couch it when you're talking about Bitcoin, right, Akiko? I mean, you've got that it is up so much year to date. It's still about 50% below its all-time high of 69,000. But this filing on the part of BlackRock for a spot Bitcoin ETF really just lit a fire under Bitcoin, seemingly.
Yeah, if anything, it shows that the confidence among those who are long on Bitcoin is still there. But, you know, I have to tell you, Julian, I'm glad you talked about sort of that high that we saw back in 2021, because we're talking well above $60,000. We are still well off of that high, but still a big turnaround when you consider just how low Bitcoin fell on the back of the FTX collapse last year. Well, shares of Virgin Galactic sliding today after the company revealed in a filing it completed a stock offering of $300 million and plans to raise $400 million more in a subsequent offering. According to the SEC filing, the new money raised will be used for development of its spaceship fleet and infrastructure to scale its commercial operations. And Julie, we're talking about declines here on the back of that big announcement we got earlier this week, which is to say they will launch their first commercial flight later this month, with another one planned for August. So it's been a bit of a roller coaster ride for the stock this week.
Yeah, and then some, right? So this, on the day that it made that announcement, the stock spiked by 27% and then proceeded to fall for the ensuing 3 sessions, erasing about 28% during those 3 days. So really coming almost not quite round trip, but, you know, erasing more those gains and then some. I think you have to think that perhaps some of the weight on the stock was also what was happening not in the skies but under the seas, right? I think safe to say with the submersible that we learned had been destroyed, just the idea that extreme travel of all kinds might see potentially some kind of pressure as the risks of doing this kind of travel were made abundantly apparent through that other situation. Whether that's reasonable to make those assumptions, I think that's something that people were perhaps thinking about. All right, shares of CarMax closing the day in the green thanks to a better than expected earnings report for the first quarter. The used car company's cost-cutting plan, which includes pausing some hiring and halting share buybacks, also seems to be paying off as it grapples with what its CEO calls a challenging macro environment and higher costs and supply shortages. We've seen a lot of volatility in the car pricing market. The company did say its average retail sales price fell about 5.5%. That's $1,600 per unit in the quarter. But it's been selling older cars as well, which I thought was interesting, Akiko.
Well, Julian, this also comes at a time where, you know, we have started to see some of these used car prices come down after being so elevated over the last year or so. So you have to wonder how much more upside there is, at least for CarMax moving forward. But at least for this quarter, some positive news coming through.
Indeed. Artificial intelligence company Seeker, which specializes in transparent content evaluation, is teaming up with adventurer and award-winning TV host Bear Grylls to launch Mission Seeker. It's a first-of-its-kind educational and adventure platform to help young digital explorers. I caught up with Bear Grylls to discuss this partnership and the importance of media literacy skills, which he says have become survival skills.
Mission Seeker is all about empowering young people with digital literacy skills. And as you know, I think for young people, this is a really pressing issue. We all want our kids, as parents, we want young people to be empowered to know what is real online, what is misinformation, what is clickbait, what's going to drag them down some weird rabbit holes, and trying to put good stuff out there. So Seeker doing that as a search engine, family-friendly search engine. Mission Seeker is about providing inspiring adventure content and getting young people to come and be part of that adventure, but get trained, get the modern survival skills, which, as you and me know, modern survival skills, being literate digitally is a modern survival skill. So that's what that's about. We've got some great young ambassadors who are going to be leading the way, setting these missions, whether they're environmental or humanitarian. And then we're just going to have tens of thousands of kids out there sending in their mini adventures for us to build that community around. But inspiring, safe space for young people to get smart online.
Yeah, and there are already some missions and some adventures that are up on the site, even as it goes live here. This is something that strikes close to home for me. I have an 11 and a 14-year-old, and they are around the dinner table will consistently bring up something and say, well, this is true. And I say, well, where did you find out that information, right? What is the source of that information? Because they do have this sort of fire hose of content. So specifically, how does Mission Seeker help them to distinguish what is real from what is not?
Well, Seeker is smart because it's AI generated to try and put those filters in place. So the information your kids are getting, can be reliable. It can not have misleading headlines that have nothing to do with the article, that the facts in the article have proper sources, that the article or the video or the link you're clicking on isn't just going to be, as I say, that clickbait that's going to drag them somewhere else. And I think sort of this gulf for young people now between getting information and the speed that information is coming at them, it's an exponential wave, isn't it? It's like a tsunami of information. And it's almost hard for us as parents to keep up with. Kids are always ahead of the game. But if you can provide them with the framework, that search engine that is doing some of that filtering for you through AI. For me, it's an example of AI for good. We hear a lot of bad stuff about AI, how scary it is. But actually, AI can be a real tool for good. And I think Seeker is an example for that.
Speaking of exciting content, you are about to launch season 2 of Running Wild with Bear Grylls, which is you with various celebrities, actors, entertainers out doing what you do. It's going to be on National Geographic. And that brings me to the idea of streaming, right? Because you have moved around a bit in terms of streaming platforms over the course of your career. How do you decide when you're making those kinds of deals, which streaming service you're going to partner with?
Yeah, you're right. I mean, we've done shows for Nat Geo, for Discovery, for Amazon, for Netflix, for NBC, for many different networks. And I think all of these are portals and windows into what inspires you. My job is to make the content, bring those adventures to life, make those adventures inspiring and accessible for people. And the platform is exactly that. It's a platform. It's a shop window into those. But I think in this modern world, there are no rules. It used to be like, oh, if you make shows for those, you can't do it for those. But it's like there are no rules. I think you create your own destiny, don't you, with so much of this. And in so many ways, the media has been like a Wild West for a while, and there's a positive part of that in the sense that it rewards pioneering spirit. It rewards people who are actually out there on the front line making stuff. And I think ultimately, if what you make is good enough, the platforms will always come to you and want it and allow you to dictate a little bit of the terms. But I'm really grateful to our partners. We always try and look after them on that trust that they give us to make good shows back. And I think actually the future of streaming platforms is really exciting. You know, it's wide open, and we can refine the stuff we're interested in more and more. But I'm not someone who kind of runs away from the progress. I think we've got to be on that front line. We've got to be creating that progress and just adapt, always being adapting, because I think the media world, the technology world changes so fast. If you're slow to adapt, you get run over. You know, same in the wild. Improvise, adapt, overcome. And it's what we try to do with Seeker. Be on that front foot. It's what we try and do with our shows. Pioneer, stay on that front line.
Yeah, I was going to say that's a pretty consistent theme throughout whatever venue we're talking about for your programming. I am curious. I mean, you're a huge name and a huge brand, obviously, and an established one. As we watch the media landscape, we have seen some retrenching, right, because of the economic environment right now. Have you found that at all? Is it any tougher to get deals done right now, or is that in your orbit of folks you deal with? Are you seeing any evidence of that?
Yeah, I think it's a totally unique landscape at the moment. I think it's incredibly tough for production companies and people making content. But, you know, I've always taken the thing of you don't want to be the complainer, you want to be the innovator. And you do have to pivot and you do have to adapt. I think it's been very hard for many of our crews. And that landscape has changed in terms of how much work they have. But I think, like I say, you've got to adapt. We're lucky in the sense that our productions are nimble, and we can pivot. We can change locations. We can improvise a bit, maybe double up in locations, maybe film more episodes there. And I think that also helps our carbon footprint as we operate and film around the world. And actually Disney and Disney Plus and Nat Geo and our partners have been incredibly supportive of that, encouraging us as a small production to think like that, think left field, be efficient. But, you know, we've done 8 seasons now of Running Wild. The show goes from strength to strength. We're still pulling in incredible guests, and I'm proud of that. And part of it definitely is having that innovative spirit, but also being grateful and honoring to our partners, to those platforms, and making sure we over-deliver. I think that's such a big part of life, isn't it? For all of our work lives is really make sure you do what you say you're going to do, deliver well, always be grateful, be nice to deal with. I think that's important. And yeah, like so much of business, rooted in relationships.
It is closing time here at Yahoo Finance. Here's a look at what to watch for next week. The economic calendar has some key data points on housing and the consumer. The latest check on home prices, the Case-Shiller Index is out on Tuesday morning. Also out ahead of the open on Wall Street, durable goods orders. And on Friday, we're going to get the May reading of personal income and spending.
Now, on the earnings calendar, it's not a terribly busy week, but there are some key names to watch. In some cases, they'll give us some indications of how the broader industries are doing. On Monday, for example, we'll hear from Carnival Corporation with a look at the state of the travel industry. Micron Technology reports on Wednesday. That'll give us a window into memory chip makers. And on Thursday, Nike reports after the closing bell. Analysts will be watching for inventory details and the company's wholesale exposure. The week rounds out with Constellation Brands on Friday morning, and it comes after we learned last week that Modelo sales surpassed Bud Light in May.
And President Biden will be making his economic pitch to Americans as he ramps up his re-election campaign. He's going to be giving a speech on Wednesday in Chicago, where he's expected to lay out his plans for the economy, which the White House says is to grow from the bottom up and middle out. This comes as the president's approval rating on the economy remains well below 50%, according to a recent Reuters poll, a result of stubbornly high inflation and recession fears.
And that'll do it for today's Yahoo Finance Live. Be sure to come back on Monday at 3 to 5 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great weekend.